Hey New Zealand, today we're going to look at what it requires to buy your first home without having to mumbo jumbo Google search for 15, 30 hours and get confused. We're going to keep it real simple. We're going to walk through what borrowing at the bank would look like, give you an understanding of your repayments and the rates that would apply if your deposit's below 20%. We're going to look at a sale and purchase agreement and what's really needed there. We're going to also look at all the costs that come with buying a house and how we are able to get cash back from the bank at the end to be able to reimburse for certain costs. So I hope you enjoy this. I'll try to power through it. I know people don't want to watch or read things for too long, so we've made this to ensure that you're able to understand all the T's and C's and pretty much how it works when it comes to buying your first home. Cool, let's get into it. Okay, so in this example, we've got a young family. There's a family of four. We've got the husband and wife earning $72,000 and $70,000 a year before tax. We're also going to be assuming that they have a $110K deposit built up of savings, KiwiSaver, all the good stuff. Everything that's done when it comes to lending is essentially done on a monthly basis across all the banks. And what we've done here is stripped the KiwiSaver and tax off the income as an approximate. And we've got 8921 per month that comes in net into this household. Now with this flowing in, we're going to look at the expenses that the banks consider. There are four categories. One is for the husband and wife to be able to just sustain and live. We're talking about the basic necessities here: toilet paper, eating, date night, all that sort of stuff. That's between about $1,800 to $2.5 grand. We've taken $1,863 as a median example here for a first home buyer. And we've taken $250 for one car that the family's got. This is not for gas, it's more for waffle, fridge, or tires, maintenance, that sort of thing. We've taken $400 ahead for the kids, so about $800 a month there. And then we've added up all of the fixed commitments that this family would have, which we've got over here: insurances, future insurances of home insurance, rates. They'll have to pay their local council the rates. Childcare and education if there's any extracurricular activity. Body corp if they're buying an apartment. So these are the fixed expenses here that the bank will consider. In this example, we've put $1,280 a month. So we know for this household to sustain a living standard, they'd be spending about $968 a week between the four of them. That's very conservative, but also slightly realistic if you're at the point of buying your first home. So that means with 8921 coming in, 4193 going out, it leaves behind 4728 per month. Now this 4728 per month is also a mortgage repayment for a mortgage at a 7% interest rate. Yup, 7%. So that's not what you're going to pay. That's not the fixed rate you'll get if your deposit's below 20%. But this is what lending is tested at currently. 9 months ago, this was over 8.5%, but it's come back a fair bit. And this allows people, especially first home buyers, to be able to enter the market and essentially purchase their first home. So with a deposit of 110 and 710 being the lending amount, your purchase price would be at about 826.55. So this family of four earning 142K has this sort of capacity, provided they've closed debts or are able to close a credit card or pay it off and they don't have any other loans. Now we understand that everyone is in a different financial situation. I'm trying to make this example very simple to understand. If you did have a loan repayment, say about $500 a month or whatever, then essentially your borrowing power would reduce to about $635 and your purchase price would be $745 as opposed to $820K. So that means your LVR. And if you're going to buy a house, you want to get familiar with this term, LVR. Essentially, your loan divided by the purchase price is your LVR at 87%. That means you don't quite have the 20% deposit to hit an 80% LVR, but you've got 13% in there to be able to determine an 87% LVR. The LVR will always equate to 100%, of which the higher bit for a first home buyer, the percentage is always for the lending and the lower amount is for the deposit or the equity in the property. So now that we've established 820K is what their purchase price is, question is, what is their repayments? So assuming that you are borrowing 710,655, assuming it's Kiwi Bank, shout out Kiwi Bank, we love you, 710,655 at a rate of 5.59%. So these rates have also dropped. There's a bit of low equity premium built into this, but essentially you're paying $940 a week for that mortgage, right? So if you're renting a place obviously the mortgage is going to be a little bit more expensive. We're not quite at the interest rate where the rent and the mortgage would be equivalent, or $30 off, where mortgage is more expensive by 30 or 40 bucks, but that's your mortgage repayment per week. Now you have to also establish the fact that when you become a homeowner, you do have to pay rates. Let's say the rates are about $2,500 a year, so that would come to about $48. And then you're also going to have home insurance, because God forbid anything happens to your property, you need to be able to rebuild it. Now, with the home insurance in here at about $120 approximately, considering you don't buy something largely exquisite, then your total cost of home ownership will come to about $1,108 per week, which is still steep. But if you're paying rent and saving $100, $200 a week, essentially it's equivalent to having a mortgage. Now, coming back to looking at your purchase price and knowing your repayments, we're now going to dive in the costs of buying a home. So essentially you have the lawyer. The lawyer handles the transfer between your KiwiSaver to the IRD back into the lawyer's trust account. And they also handle registering you on the title, liens, all that sort of stuff. They also handle the money that comes from the bank to their trust account to give to the vendor, and any negotiations or correspondence between you as the buyer and them acting on your behalf towards the vendor's lawyer. Now the valuation would cost maybe $1,000, could be less, $850, depends on the house, depends how urgently you need it. The reason there's a valuation here is because you're buying a property with less than 20%. Normally 99.99% of the time you'll need to get a valuation done. The bank wants to make sure if they're lending you 90% of the money or 85% of the money, that the value of the property at least comes back to your purchase price, right? The building report, obviously you don't want to buy a lemon, you want to get your checklist done, whether there's a leak or there's anything on the windowsills or whatever. That'll cost between $300 to $600. They can just go around the property, have a verbal one and tell you what's wrong with it, or you can get an actual report written, which is more expensive. And then we have the lim. The lim's like a little logbook of the house, what's been consented, what's not been consented, any unauthorized work. Can be ordered urgently from the council as well. Now, when do you need all of this? After you've approved it, when you've found a place, put in a confirmation as due diligence or solicitor's confirmation. Valuation after you're approved on the mortgage and when you've found a place. Building report, same thing. And lim, sometimes provided by the person selling the house, but chances that you might need to buy it because you just want to be sure that if you're buying something for $800K, you want to make sure it's in good nick. And then these are some of the reasons that we've already spoken about. So now we're going to move on to what a sale and purchase agreement is. So now imagine yourself, you're at the open home, you found the house, essentially you're happy with it, and you're purchasing this house on the 8th of April. In this example, you're saying back and forth on the price, and you're saying $900 is a price you're happy to pay for the house. You'll pay an $80,000 deposit provided the conditions in this part here are met. So now this person's condition is that their mortgage has to be approved in 10 working days. The lim report has to be satisfactory to them in 10 working days, and the building report has to be good as well. If all three of these are green light, then basically you'll pay $80,000 on the 10th working day from here. The working day starts from the next day onwards. And once you've done that, you will settle on the property, meaning the mortgage money from the bank will come to pay this person you're buying the house off on the 23rd of May. In this example, you really just want to make sure all three are green light. If the building report is clean, your mortgage broker's got you a great approval with the rate, but the lim report is not that great, you can back out essentially. So you'll only take the risk of buying this property if you're happy with all three of those conditions. Now, once that's done, you will be waiting until settlement. There's a few other bits and bobs in here, but this covers high level bulk of it. I hope you enjoyed the video. And if you have any other further questions, please reach out to us. We help a ton of first home buyers. I would love to give you any assistance that you need. We hope to hear from you soon.